Our second presenter, our second presenter today is Christian Auger. Christian is head of client strategy at NEAM. He's responsible for delivering investment and capital management services to their clients and is a member of the firm's policy committee. He joined the firm in 2008, having previously been an assistant treasurer and portfolio manager at Hanover Insurance Group, a regional P&C company in Massachusetts. Christian holds a BA in economics from Clark University and is a CFA charter holder. He's been employed in the investment industry since 2000. Please welcome to the Zoom stage, Christian.
Good afternoon, everyone. First of all, just a check. Can you see the PowerPoint?
I can see the PowerPoint, I can see you, and I can hear you.
Perfect. Well, first of all, thank you very much for having me here today. I really appreciate the opportunity to talk with you. And I'm going to talk about our thoughts on the U.S. economy. And I named the presentation Economic Cross-Currents and Crossroads, with the reason being that I really do believe that we are at a crossroads here in the U.S. From an economy standpoint, probably more than just from an economic standpoint, but certainly from an economic standpoint. And there are really, three paths that we can take at this point, three outcomes: hard landing, a soft landing, or no landing. And you've probably heard these terms bandied about over the last year or so, but just to define them for this presentation, both the hard landing and a soft landing assume that inflation comes down. And so essentially the plane landing coming down to earth is inflation coming down to earth. A hard landing is we fall into a recession as we move to get inflation lower. A soft landing is that we actually stay out of a recession and still get inflation lower. And those were really the two prevailing assumptions that what the outcome would be for all of 2022. One of those two was what was going to happen. But so far this year, a new term came to being, which is no landing, and is becoming a little bit more and more of a possibility. And really a no landing is, the plane is not coming down, and so inflation does not fall, and we're kind of stuck in a period where inflation stays elevated for an extended period. And then I mentioned the word cross currents in the title because we're looking at economic data day in, day out, and it is just not obviously pointing to any one of these outcomes. A lot of the data is contradicting each other, pointing in completely different directions, making it very difficult to determine, what's going to happen in the U.S. over the next, call it 12 to 18 months. And as a result of that, making it very difficult to position portfolios. So what I was going to do today is just talk about the data that we're looking at, the most important data we believe to look at: inflation. We're going to talk about the labor market, the housing market. I'll touch upon the banking crisis that just occurred this March. And then I'll just end with some thoughts on what we think is going to happen. Do we hit a recession? Which of the three outcomes is the most likely? And then briefly just on how we're positioning portfolios as a result, just from a very high level. But let me start with the inflation story. And, I titled this one, Inflation Still an Issue, because it is. So this shows four different inflation gauges, both headline inflation and core inflation. Headline inflation is a basket of goods, including energy and food prices. Core inflation excludes energy and food prices. Energy and food prices are very volatile. And so it's important to look at both headline and core CPI to get a full picture of what inflation looks like. And I'll just start with the headline CPI, or Consumer Price Index line item, which is the dark blue. This one includes food and energy prices. Peaked out at a little over 9% mid last year, and has come down quite nicely since then, running at around 6% today. And a lot of that drop had to just do with the fact that oil prices and energy prices in general have come down quite a bit over the last 8 months or so, and that's really driven that gauge lower. The green line is core consumer price index, so it's the same data series, but just excluding that food and energy price component. And what happened here was we peaked at around 6.6%, call it in September of 2022. and really came down quite nicely through the end of 2022. Went from 6.6 down to about 5.7% over just the last few months of the year. But what's happened more recently is it's stabilized. Every month since December, core CPI has come in at least at 5.5% or 5 to 5.7% every month so far this year. And so that stability has been pretty shocking, pretty unexpected, and has caused some concerns within the capital markets as a result of that, and why we started to get the term no landing, and maybe the possibility that inflation doesn't come down as much as people were expecting. And I wasn't going to talk too much about what got us into this position, into this inflation position, but I thought just as a quick level set, a couple of slides as a bit of a look back. I would say that inflation really started to creep up in February, March of 2021 due to the Ukraine-Russia war. And what that did was just cause a huge spike in energy prices. Russia's a big exporter of gas, as well as commodity prices. Ukraine in particular, a big exporter of many of food goods, and that just caused a huge supply dearth, and prices moved up quite sharply during that time frame. Now, and you can see more recently it has come down, but it definitely did act as a bit of a springboard for inflation. Now, that wasn't the big reason for inflation. Really, the big reason that we saw inflation as much as we did was because of our reaction to COVID. Essentially, and I don't need to rehash this, you all are aware, but the government did shut down most of the economy, particularly the services side of the economy, things that we could do, like going to the movies, going on vacation, going to restaurants, going to the movies, going to concerts. I mean, all that stuff was shut down for an extended period of time. But at the same time, the government was flooding the market with cash, giving households checks in the mail. And so we as consumers were flush with cash and didn't really have a lot to spend it on and things to do. So we spent it on goods. And so what this chart shows is goods inflation in the green line, and then services inflation in the blue line. And what you can see is that the goods inflation spiked quite a bit just due to large demand spike as people had a lot of cash, and very limited supply, because not a lot of people were really getting back to the office to make the widgets, the goods that we were buying, and international trade was choppy at best, and so supply lines were quite an issue, and so we saw a big spike up in the price of goods as a result of that. Now, again, much like we saw with the energy prices, we've seen a nice drop off in goods inflation since, call it, midpoint of last year. And that is really just due to the fact that the government has opened up the rest of the economy, the services side of the economy, and have allowed us to spread our spending out quite a bit. Now, the bad news on that front, at least as it pertains to inflation, is you can see that service line, which was pretty stable through all of 2021 and even into 2022, has now really started to move quite a bit higher. So inflation on services is now moving up, and it's offsetting most of the benefit that we're getting from the goods side, moving quite a bit lower. I would also add that in addition to just opening up the economy, one of the things that's causing service inflation to move higher is that wages are moving up. The biggest input for any service company is going to be human resources, paying their employees. And so as wages have moved up, so have prices, and they've pushed those on to consumers in the form of higher prices, and that's caused inflation to move higher. So ultimately, we have an environment where this disinflation progress has stalled. And unfortunately, it stalled at a point that's quite a bit away from the Fed's target inflation, which is 2%. So this puts the Fed in a bit of a bind, and I'll talk about it a little bit more in a minute, but the Fed really planned on getting the Fed funds rate to, call it around 5%. We're a little bit above that now, but the plan was to get it to above 5% and then keep it there, and just continue to watch that disinflation come through and inflation get closer and closer to the target of 2%. But now, because it's stalled, they're in a bit of a quandary. It's okay, do we kind of stay where we are and wait this out and hopefully it continues to drop over time? Or do we have to be a little bit more forceful, maybe move rates up another 25 or 50 basis points to give it the nudge that it needs to take another step down? And the issue is that the more they move rates higher, the more likely a recession becomes. And so they have a difficult decision to make. And again, hence that kind of crossroads concept of what are they going to do, not just from the overall economy, but the Fed is also at a bit of a crossroads. Now, this unexpected stalling in the disinflation trend has wreaked havoc on the capital markets. And it really can be traced back to investors' expectations of what the Fed is going to do. So, and I try to illustrate this in this graph, and I apologize, it's quite busy, but really what I'm showing here is, this shows what the Fed has said they're going to do to the Fed funds rate in the blue line. So the Fed has come in and said, look, we're going to get the Fed funds rate to around 5%. We're going to keep it there for an extended period. This shows to the end of 2023, but likely into 2024. When we came into 2023, again, recall that inflation at that point was still coming down from that 6.6% into the 5.7%. So investors entered the year and said, hey, we won, inflation is no longer an issue. Now we have to be concerned with the fact that the Fed has raised rates 500 basis points and likely pushed us into a recession in the near term here. And so they were projecting that the Fed was going to have to cut rates about 75 basis points in 2023. Okay, so now what happened, if you look two months into 2023, you look at February, now we've had a couple of inflation prints that are showing, oh boy, that disinflation picture has stalled out. We're not seeing it come down as like we thought it was going to. And so what the investors said was, okay, the Fed is wrong. They're not going to keep rates at 5.1% throughout the year. They're actually going to have to raise it up to close to 6%. Forget what I said about a recession being an issue. We have to worry about inflation again. So we're not going to cut at 75. We're actually going to raise it to 5.7%. And that's what that green line is showing. It's what investors were expecting the Fed to do in around that February timeframe. And then March hit, and we got the banking crisis, and investors overreacted once again, did a complete 180 and said, holy crap, don't worry about inflation. We have to worry about a recession again. This banking crisis is going to bring us back into a recession. And that's what that light blue line is. That's what investors were expecting was going to happen to the Fed funds rate in March of this year, that the Fed was going to have to cut all the way down to 4.1% by the end of 2023. And what's happened since is, as the bank crisis has become a little bit more in the rearview mirror, investors have kind of crept back up to what the Fed was saying all along. That's the orange line. I drew this back on 5/17. If I redrew it today, they're basically right in line with what the Fed is saying. And so you had the Fed that was very steady Eddie throughout the year saying, this is what we're going to do. We're going to stay here. You had investors like this, on every single data point that was coming out, changing their mind to a large degree in terms of what the Fed was doing. And it was just wreaking havoc on the capital markets, particularly the Treasury market. We saw Treasury yields moving all over the place. And I think, again, this is another good illustration of just the cross currents that we're seeing and the crossroads that people recognize that we're at. And it's just so hard to determine which way we're going, and people are pricing in big moves. It seemed like, for the first few months of 2023 on a daily basis, it was all over the place. Now, from our standpoint, we do believe that, and we've believed all along, that the Fed was going to be steady Eddie through 2023 and into 2024. We felt that there was very little probability that they were actually going to cut interest rates this year, even if we hit a recession. And the reason we felt that way is because we do believe that they're looking at the early 80s, which is the last time we had inflation this high, as a case study in what not to do, and then ultimately what to do. They learn their lessons from what happened in the early 80s. So just in what this chart shows is Fed funds rate in the blue, inflation in the green, and the period that we're showing here is mid 70s to mid 80s. And so, just for a little bit of a history lesson, 70s, late 60s into the 70s, absolute disaster for price stability. Inflation was high for an extended period of time. And what you'll note is that the blue line on the left side of the page, which is the Fed funds rate, was still pretty low, despite inflation being at that 12% between, call it 7 and 12% in the late 70s. The Fed funds rate was pretty low. They weren't really using it to fight inflation. And in fact, Nixon infamously put in place price and wage controls and used that to try to fight back on inflation instead of using monetary policy, which ended up being a total disaster. It just caused supply issues and inflation stayed high. But they didn't want to use monetary policy because when you raise interest rates, it tends to increase the unemployment rate. And that's a no-go for any president. You don't want to see the unemployment rate go higher. And so they tried to do other means, and it caused inflation to stay high. 1979, Paul Volcker, a new Fed chairman, steps in and says, forget this. We can't be doing this other stuff. We need to use monetary policy to get inflation in control. And so you can see what happened to that Fed funds rate from 79 to 1980. We raised it up to about 17.5%, the Fed funds rate, as inflation was continuing to move higher to really push it down. Now, the gray bars go on the page are recessions. And so what happened in 1980 was we hit a recession. Unemployment was high, which is expected because the Fed funds rate was so high. But Volcker got a ton of pressure to cut interest rates because of the recession, because of mass layoffs. He was pressured to cut interest rates, and that's exactly what he did. Dropped it all the way down to about 9%. And this is considered the Volcker mistake. This was the big mistake by Volcker. He caved to the pressure, tried to fight a recession while inflation was still high. And what happened? We still hit a recession. We still had unemployment rates high, but inflation stayed elevated. And so he very quickly reversed course, recognizing the mistake, and raised the Fed funds rate back up to between 15 and 20% for an extended period until inflation finally got under control and came down. But Volcker's thought process that second time around was, look, we can get through a recession with time. And it's not generally going to take too much time to get through a recession. Typically it's 6 months to a year, maybe 18 months. But what will stay with us forever is if inflation gets into the consumer psyche, if the consumer starts to recognize that inflation has to be priced in, that's going to cause inflation to stay high for longer. And so his number one priority from that point was getting inflation down and really, took a hatchet to the Fed funds rate to do it. And it ended up working. We ended up learning a great lesson. And we think that Powell is going to take that to heart this time around. And keep in mind, the Fed has 400 economists on staff. And they did not see this inflation coming back in 2021. Recall, they called it transitory. They got it wrong. So this time around, I don't think Powell is going to be very interested in hearing from these economists, oh, you know what, inflation's coming down. It's not showing yet, but it'll start coming down soon. So you can start easing off the pedal on the Fed funds rate. He's going to want to see the actual numbers coming down before he actually makes any change to policy to cut rates. And so that's why we think we'll stay higher for longer here. So, the thought process is slowly becoming, maybe to take that next leg down in inflation, we need to see a slowdown in the economy and maybe even a recession in the economy. And the U.S. economy is 70% consumption. As goes the U.S. consumer, so goes the U.S. economy. And so I think it's important to take a look at the strength of the consumer to figure out, if we could see a slowdown here. And I would say that generally the consensus up to this point, really since COVID, has been to underestimate the consumer. And we think it's probably time to stop underestimating them. We think we're seeing signs of some strength here and some stabilization. And we think that they could continue to keep this economy afloat for a little bit here. And so first of all, you think of consumption, really three ways a consumer can consume: use of assets, use of income, and then use borrowing. So use of assets is using your savings account to buy stuff. Obviously, use of income is using your paycheck. And then in a last case resort, you borrow to spend. And when you look at those first two, we're seeing some pretty positive things coming through. So first of all, I'll start with the personal savings rate as a percentage of income. I spoke with you a couple of years ago at this conference, and I showed this graph and spoke about how really since the great financial crisis in 2008, the average savings rate here in the US was about 7% or so. And at the time when I spoke, the savings rate was down to about 6%. And my sense was the consumer was pretty close to being tapped out at 6%. My sense was they're probably going to want to keep a little bit more in their savings account than the average of 7% since the great financial crisis, because now yet they have really two big negative events that have occurred, 2008 and COVID, that they're going to want to probably keep a little bit of dry powder available, a little bit of extra savings for a rainy day. But boy, was I wrong. That just did not happen. So we have is shown here, the savings rate spiking up to about 35% as those fiscal stimulus checks came in the mail. But then we started spending it down. Again, we got to that 6% when I last spoke to you. We got all the way down to 2.9% recently. So lowest we've ever been, 2.9%. And it just showed that the consumer just continued to spend with disregard for, hey, COVID is right. That what happened with COVID, what happened in 2008, they just can continue to spend. But what I'm more interested in is that little fish hook on the right side of this chart that shows that we've actually gone from 2.9% back up to 5% in the savings rate. That bodes very well. They're building back up that savings, and that is good for future consumption. And one of the reasons that they've been able to rebuild their savings is because incomes have improved. So this chart shows on the top graph the same savings rate that I just showed, just in bar form in a smaller time frame. This just goes back to July of 2021. That low bar, I'm not sure if you can see my mouse, but this low bar here in the middle is the 2.9, and we've seen a nice little increase up to 5% since then. But the important thing is this bottom chart. This is real disposable income, so growth, and so month over month growth. So this real disposable income is just your income adjusted for inflation. And so we had a number of months in 2021 into 2022, negative real income growth because we saw inflation moving up and we saw wages staying the same. People just were not resetting wages at that time. They were staying the same. And so every day that they were walking in, they were making the same amount of money, but they had to spend more to buy the same things. And so they were seeing negative growth in their real disposable income. But what happened really since July of 2022 is that trend changed. We've seen now only positive month over month growth in real disposable income. What happened? Well, people started resetting their wages higher. Inflation stayed high long enough where employers recognized that they needed to pay their employees more, otherwise they were going to lose them. And so they started paying them more and more than the inflation. And so we started to see that real growth, and that allowed them to start rebuilding their savings rate, which is a good sign again for things to come. And so as a result of all this, I mentioned that the consumer has been underestimated. We should probably stop doing that, but this shows nominal consumer spending all the way back to 2016. That orange line just shows kind of the trend of spending growth that we had from 16 to 19. If you really go further back, that trend line is pretty much the same slope. And it just shows, how much more we're spending than we typically would have if not for COVID and all of the adjustments that were made from COVID. We basically more than offset anything from negative side from what happened during the lockdown. And I think a good indication of the strength of the consumer and the consumer's continued willingness to spend. Can't get a full picture of the consumer without looking at the labor market. And, I would just say the labor market is still very strong. And I'm sure you're probably pretty aware of it. A lot of really good numbers coming out, but starting to see some signs of cracking, not a ton, but definitely seeing some cross currents in this data series as some of the other. I mean, if you think of the labor numbers, there's just a ton of data on it, a ton of different data prints that come out. And some of them are definitely showing some signs of weakness that I'll talk about in a second. But first of all, this chart is showing a labor market imbalance. We have in the green, which I think is the important one, the green area, job openings, which got up to about 11.5 million, higher than we've ever seen it before. Importantly, that blue line going across is the job openings to unemployed. So this is the number of jobs that are available for every unemployed person, and that peaked out at 2. So you had 2 jobs for every unemployed person in the US. Huge numbers, like we've never seen before. and just a good indication of the strength of the labor market. Now, what I will say, though, is that number has come down recently, and this is you're starting to see some signs of weakness. That number has gone from 2 down to 1.6 jobs per unemployed, so still very high. And I think that's a theme. We're still seeing numbers strong, but just slowly weakening a little bit. And I think that's the first one that we would look at that shows that. One of the reasons that we're seeing such strength in the labor market is a dearth of supply, of labor supply, definitely a supply-demand imbalance. You're seeing high demand as shown by the job openings, but the supply is down quite a bit, actually. What this shows, the green line, is the U.S. labor force participation rate, the civilian labor force participation rate, which is everyone involved, anyone 16 to 50 to 64. And, the number has not returned to where it was pre-COVID. And this is a very simple calculation of, everyone in that population, what percentage are either working or looking for work. That's on the left-hand side. So we were at about a little over 63% of that population. And now we're at about 62.5. So, call it about 75 basis points under where we should be. Now, it isn't the prime working age people that are not coming back to the labor force. That's the blue line. And it shows that, and this is anyone 25 to 54, that's considered the prime working age. That time series has gotten back to where it was pre-COVID. Really where the weakness is the 55 plus. And I'm sure you've all heard of the early retirements that have occurred, people just deciding when it was time to go back to work that they're just going to hang it up for a career and not go back. And these numbers are real. I mean, they're big numbers. It's a 2 percentage point drop in this labor force participation rate from 40% down to 38%. And that's a big deal because it's, you think of the people that are 55 years and older, the amount of experience, knowledge that they have in their industry, is going to be unmatched. And so you're losing that. All the employers are losing that as these people decide to hang it up early. And not only that, but you're also getting this labor shortfall, not enough bodies, not enough people willing to work to satiate the demand for labor. So when you take into account the excess retirements, which is about 2 million in total, you add to that a couple of other factors. One, COVID deaths, but then the bigger one is immigration. So for a couple of years due to COVID, work visas were basically shut down. And so the amount of immigrants that we had coming in to take jobs was shut down for a couple of years. And that's about 1.5 million in total that we've lost as a result of that. It's a total of about 3.5 million people that were short. And that's a cause for concern. And one of the reasons that we're seeing, I mentioned the fact that we have we've seen some wages increase recently and getting to that positive real income. The reason that is because of, or one of the reasons is because of this time series here, employment cost index, up at around 5%. So people are getting wage increases of about 5%. The Fed looks to target around 3.5%. Typically, when they want to keep inflation at around 2%, they look for 3.5% on wage growth, and we're at 5%. So quite a bit is a ways from that. And this is important because, you think of inflation and the stickiness of inflation. One of the things that, can really cause a spiral of inflation to move higher is higher employment costs. As wages go higher, that means employment costs increase. That means the input costs for goods and services increases. That means people who are selling goods and services have to increase their price. As prices go up in general on goods and services, employees look for more wages, and it becomes a vicious cycle pretty quickly. And so this is something that, again, is starting to come down, which is good, but something we need to keep a close eye on, because if we stay elevated here, that means we're going to probably have inflation with us for an extended period of time. This graph really just more for informational purpose. I thought it was interesting, so I figured I would throw it in here. Not really relevant to today or kind of the 12 to 18 month period that I'm really talking about. This is more longer term, but the situation on the employment side is not going to get improved anytime soon. This shows the graying of the U.S. or people that are 65 years and older in the U.S. as a percentage of the population. We're at around 18% currently. but it's not going to be too long until we're into the low 20s. And it's just going to be an issue that we need to think about. We need to deal with. There's just going to be a lot of people that are not working anymore because they're retired, and less people picking up the slack as a result of that. And so just something we need to be cognizant of. We are seeing, as I mentioned, mixed signals in the labor market. One of them, a couple of things that we're looking at. One is the difference between the household survey and the payroll or the establishment survey. So I'm sure, I shouldn't say I'm sure, but you may be aware that there's a non-farm payroll number that comes out every month. That's a number it's just a survey of businesses. How much have you increased or decreased your payrolls in the month? There's also a household survey where they don't call businesses, they call people at their home. And they ask, hey, do you have a job? If not, why not? Asking those types of questions. And that's the number that the unemployment rate is based off of. Now, typically these two time series, are pretty close together. They're kind of showing the same signal. But what we've seen more recently is a little bit of a divergence. That household survey is coming in a lot weaker than the payroll survey, which continues to be very strong. And historically, the household survey has been a better indicator of kind of future trends in the employment market. And so that's something that we should be keeping in mind of showing some weakness in labor. The other number that we look at is the initial jobless claims, which is it's a weekly number that shows how many people have applied for unemployment insurance. That number has been in the low 200s for quite some time. Over the last few months, it's increased to about 250,000 or so. And just today, actually, it jumped again to 261,000. And that's shocked the markets quite a bit, and where markets are reacting as a result of it. But so a couple of things we're looking at that are showing a little bit of weakness. Just to give folks some sense, when we're in a recession, typically you see that initial jobless claims reaching 400 to 500,000 people. And right now we're at 250. So still a pretty benign number, but going in the wrong direction. Let's move on to the housing market. And, this is an interesting one because coming into the year, pundits were pretty adamant that this was going to be a big issue, that the housing market could see a pretty good drawdown. Prices could drop quite a bit, owed to the fact that mortgage rates were so high. We got as high as 7%, over 7% for a little bit there. And the assumption is, hey, 7% mortgage rates, that's going to take a huge number of people out of the market in terms of demand for a home. Particularly new home buyers aren't going to be able to afford a 7% mortgage rate, and that was going to cause prices to crumble. We weren't so sure about that. We actually didn't subscribe to that at all. We thought there would be a little bit more stability in the housing market. And it was really for a couple of reasons. One, there is an imbalance in the housing market. And there's just not enough homes for the number of households that are out in the US. And what this data series shows is a couple of lines, but really a running total of the difference between the number of houses being built, called housing starts, and the increase in household formations during that time. So it's a cumulative time series. The blue line shows the shortage of, the green line shows the shortage of single family homes. And it's at around 7.5 million homes that we are short. So we've definitely seen a lot of household formations over the years and very limited housing starts, particularly new homes. When you add in multifamily, just as another option for lodging, the numbers aren't so bad, only about 2.75 million, but definitely a shortage of housing, of supply of housing. And we felt that was going to keep a bid in on home prices, at least to some extent. Another way to look at it, and the reason that we have such a shortage in home building is just, you don't have to look any further back than 2008 and what happened there. This chart shows household formations, less housing formation, housing starts, less household formation. So same time series, but just not cumulative. And the orange line going across shows the zero bound. And so anything above that zero bound, you're essentially saying that more homes are being formed than households are being more homes are being built than households being formed. Anything below the line, the opposite is true. The vertical line is just in 2008. I just drew it down to 2008. And as you look to the left of that arrow, what you see is generally the line is above zero. So we're building more homes than households were being formed. And that is just owed to the fact that a ton of demand for households back then. You had, easy access to mortgages, didn't really have to show, income or assets to get a mortgage. And so demand was really elevated. And home builders assumed it was all real, and they built homes with that assumption. Turned out that demand was not real. It was artificial demand. A lot of the people that were able to get mortgages really shouldn't have. They didn't have the income to do it. And it all came crumbling down. And so when you look to the right of that vertical line, you'll see that generally that blue line going across is below the zero bound, meaning that these home builders are a little gun shy right now, not really willing to build for the demand that's out there, and that has caused that imbalance that I spoke about. The other reason that we didn't buy into the fact that home prices were going to drop substantially is the fact that yes, mortgage rates were moving up quite a bit, but here in the U.S. we have this crazy mortgage market where you can lock in a mortgage for 30 years. And oh, by the way, if interest rates drop at all during that 30-year period, you can very cheaply refi into a lower rate. And what does that mean? That means that people that are in homes now, mortgage rates are extremely low and are going to be low for quite some time. So what this shows, the dark blue line is current mortgage rates. So you can see that vertical line moving up, showing that current mortgage rates were moving up very swiftly. The green line, though, going across is the average, the rate on outstanding mortgages. So, and that's a left-hand side stat. So 3.75% is the average mortgage rate outstanding here in the US. So, people have locked that in over the years. The last few years we had 0% interest rates, very low mortgage rates. Everyone locked in a lower rate. And the idea being that, look, if are we going to see some drop in demand because mortgage rates are high for new entrants? Absolutely. But if you have someone that's sitting in a home with a 3.5% mortgage rate or 3.75% mortgage rate, they're going to want a premium to move on from that home because they know they're going to have to get into a higher mortgage rate on the next home they buy. And so they're going to look for a price pop for them before they're willing to sell their home. And so that was going to at least somewhat offset some of the downdraft from the weaker demand from higher mortgage rates. And, as it turns out, at least up to this point, we were right. We were calling for somewhere between a 5 and 10% drop in home prices, which, coming after a period of home prices just moving higher and higher was really no big deal at all. This shows month over month change in home prices. Over the last handful of months, you can see we moved into red, into negative territory. But that last little line on the right side is above zero. And so we think we may have bottomed here. And from the peak, we're down about 4% nationwide. So, hopefully that is a bottom. And if it is, this is probably a positive story for the U.S. economy because homes are the biggest asset on household balance sheets. And so when you're pretty confident that you have a stable investment in your home and prices aren't dropping, you're definitely more willing to spend. And so that could bode well for the future here. Okay, so those were some good kind of happy thoughts. I want to get into some of the negative things that are happening or that we're concerned about in the U.S. that could cause that hard landing. And I'm going to start with the banking crisis. And what I would just say here is that it's not necessarily that we think that the banking crisis as it formed in March is still ongoing and is going to be an issue. But what it did show, I think, is that we just need to recognize that what the Fed has done over the last handful of years, what the federal government has done in general, is going to have unintended consequences. And no one saw this banking crisis forming. When you look back in hindsight, it's like, oh, geez, that makes sense. And I'll talk about why, but no one really saw it. And so what else is creeping under the covers that's going to come percolating up over the coming months that we're not thinking about? And that's really kind of the theme I'm getting to here. But just to talk very quickly about what happened to the banks and why the crisis ultimately occurred. This shows the effects of the massive monetary and fiscal stimulus had on banks. And what it shows is very simply just a long time series back to 73, total deposits and total loans. Blue line is deposits, the green line are the loans that the banks were putting together. And these two were pretty good travel companions for most of the last handful of decades, up until 2008. Then you started to see loans coming down, but then they kind of returned to their normal trajectory that you could see occurred in the 70s and 80s. Deposits, on the other hand, never dropped, and they kind of moved into more of a parabolic form on this graph, and continued to move higher and higher, particularly when we got to 2020, which is, you know, this almost vertical line here. And again, you think of not just the fiscal stimulus payments, some of it went into deposits, but also quantitative easing. The Fed was literally printing money to buy bonds. When you're selling the Fed bonds, they're giving you cash, and some of that was finding its way into bank deposits. But you know, ultimately, we did see deposits moving up quite substantially. But importantly is that little fishhook again on the right side. You know, generally what we would say is, you know, this, first of all, first time bank deposits ever dropped in the US. Second of all, you know, I would say that bank management teams generally were expecting some drop in bank deposits. And so I think they were relatively prepared just for that initial deposit decline. What they, I think, were surprised about was how long the outflows have lasted. And I'll show you a chart in a second that just shows a little bit better, shows how long this has gone on, and has definitely caused some issues. So, you know, you look at this chart shows the securities as a percentage of assets on bank balance sheets. This number got quite high. So banks, and I'm not sure how familiar you are all with your respective insurance company portfolios, but over the last decade plus, you know, with the rate environment very low, insurance companies have been, you know, adding risk to their portfolio, adding duration to their portfolio in an attempt to replace the yields, the higher yields that are rolling off, that are maturing on the portfolio, trying to replace those higher yields. So they've been taking more risk to do it. Banks have been doing the same thing recently with that huge, that increase you're seeing here in assets in 2020. You know, they've been putting it out the curve. Interest rates were very low, so they weren't really going lower in quality. That's not really what banks do. What they were doing, though, was extending duration. They were taking basis risk to try to get as much yield into the portfolio, try to make as much money as they could on those deposits. And that all worked out fine until 2022 happened. Rates moved up a ton, and all of a sudden they found out that their securities were underwater at big unrealized losses. And so when those deposit outflows came, they really had nothing to sell to cover them because they couldn't take losses and have that big hit to equity. So ultimately, what happened to Silicon Valley Bank, and I think this chart shows it very well. This just shows a number of big U.S. banks and the percentage of securities that they have as or the securities that they have as a percentage of total assets. And Signature Valley right there in the middle, above and beyond anything that any of their competitors had. And ultimately what caused their downfall. Now, if they just had this, it wouldn't have been a big deal. Really, what was the big issue was their deposit base. Their deposit base was, you know, very concentrated from an industry standpoint, from a geographic standpoint, and from a corporate standpoint. You know, a lot of banks have, you know, a lot of personal bank accounts and some corporate bank accounts. Silicon Valley has 95% of their deposits at corporate accounts. When you think of a corporation, a lot of corporations are going to have a lot more than $250,000 in the bank, just for, you know, working capital to kind of go through the day. You know, they're going to have millions. And, you know, the FDIC deposit limit is 250,000. And so it doesn't take too much for, you know, a little bit of bad news, a little bit of concern or loss of confidence in the bank, and you're going to take your money out, because, you know, if something does happen to that bank, you're not going to get all your money back because it's not guaranteed. And that was ultimately what caused the fall in Silicon Valley, was just the fact that they didn't have much in deposits that were under 250,000, and people took their money out in droves, and the loss of confidence continued to the point that they no longer were a going concern. And just, you know, 96% of Silicon Valley's deposit base was uninsured, which is just a huge number, and the reason for their demise, unfortunately. And, you know, I guess as we look forward, and again, we don't think that there's going to be an issue specific to that's going to occur, but as we look forward, the banks are not out of the woods yet. You know, one of the issues that we're seeing is that people are a lot more cognizant right now of higher yields that they're able to get in money market funds over their deposits. So you think of a checking account, it's not really getting any yield at all, any return at all. But money markets are getting about 5% currently. And so people are very cognizant of that, and we're seeing, big outflows of deposits and people moving just into money market accounts, which are still liquid, not, you can't write checks on them, but pretty liquid. And so people are trying to run down their balances as much as they can. And I mentioned before the decline in the deposit base and how long it's lasted. Well, the green line, this is a shorter time series, so I think you can see it better. But that green line starting really in November of 21 started to come down. That's deposits coming down, and it's just been a slow slog lower and lower. Again, this is a country that has never seen a drop in deposits. So, this is very unprecedented, and has caused a lot of issues, obviously. So we need to be concerned that trend continues, that we continue to see deposit outflows. But from a higher kind of macro level, when banks are not doing well, when they're concerned, they tend to tighten their credit standards, make it more difficult to get a loan. And this is for corporations, this is for people, and that's not a good thing for economic growth. So this time series shows the percentage of banks that are increasing or tightening their credit standards. So the higher this line gets, the tighter the standards are, and the harder it is to get a loan from banks. And it's moved up quite a bit, which is understandable, but usually a pretty good predictor of a recession. When people can't borrow money, it's harder to spend. It takes away one of those levers that they can pull to spend. And certainly with corporations, if they want to continue to grow, if they want to continue to hire, make payroll, a lot of times they have to borrow. And if they can't do it, that's not a good thing for, for growth. And we could see this coming up over the coming months. And certainly something we're looking at is something that could cause a hard landing over the next 12 months or so. And then one last thing about the banks that I want to point out is commercial real estate. And yeah, you've probably heard some of the news about commercial real estate. Obviously, an issue with particularly office properties, as people and companies try to figure out their way around the work from home policy, the hybrid policy, reducing their footprints on office properties. There could be a case made that commercial real estate values drop quite a bit here. That's not really something that's going to impact the bigger banks. Unfortunately, this is going to be more of a community bank issue. So, and that's what this is showing, is that, big banks as a percentage of their overall loan book, it's pretty small. Commercial real estate, that CRE commercial real estate, only about 9%. When you get to the small banks, it's 43%. And so, it's something that could be pretty widespread across the country. In banks that are not, systemically important, and so something that we need to consider and keep an eye on. Okay, so just to wrap up here, I'm at around 48 minutes. Just some thoughts on whether or not we hit a recession. First of all, wanted to give a sense of what the overall kind of economist think. At least when we came into 2023, what they were thinking the probability of a recession was, and it was 65%. So there was and I mentioned this earlier, everyone was expecting a recession in 2023, or at least a very high probability of it. 65% is just a massive number to predict a recession. And you can kind of see here, as you look at the projections for GDP, why it was so high. First quarter GDP was expected to come in okay, but second, third, fourth quarter were either negative or right around zero. So it wasn't going to take too much to push us into to a recession. Now, what I will say, first quarter GDP came in around expected 1.1%. Second quarter GDP, it obviously doesn't come out until July, but the Atlanta Fed does have a kind of a GDP tracker where they try to give a sense of, or an estimate of what GDP will be based on the data that's come in to date. And right now, the Atlanta GDP is coming in at 2.9%. So if that's the case, we've blown the expectation out of the water. We still have some time to go. Who knows what happens? But at this point, we're definitely tracking much better numbers. And that's owed to the fact, some of the things I talked about, the housing market doing better, the consumer doing better, is all coming in with, pretty decent GDP expectations for the second quarter. But, definitely some cross currents here. Manufacturing index. This is the ISM and S&P index, which basically is just a survey of a number of companies that they do every month. Anything under that 50 bound is indicating that the company is in kind of contractionary territory. ISM is well into that contractionary territory. There's also one for non-manufacturing or service. That one has been above the 50 line for some time now, but just the most recent data print, and it's not shown here, has come in at 50. So we've gone from above 50 now to at 50. Manufacturing has been below 50. And so things are definitely trending in the wrong direction when you look at that. And then a leading indicators index, which has been it's historically a good predictor of a recession. And this tracks a ton of different data points: average hourly earnings, initial jobless claims, which I spoke about, new orders for consumer goods and materials, the shape of the yield curve, a lot of different things. But it's definitely, and that's the blue line, definitely showing signs of stress and signs that a recession is upon us, which is a concern. And I would also just point out the gray line going across is GDP. And we're slightly above trend, at least up to this point. You can see, trend has been kind of that 2.5%, 3% range. And, we're, not too far above 1. So we're definitely below trend and so not too far away from a recession. So we need to be cognizant of that. And then I would just point out that, look, a lot of people are pointing to the labor market as something that's like, hey, how are we ever going to get into a recession? The labor market is so strong, you really can't paint a picture that a recession is upon us. And what I'm trying to show here is that, an unemployment rate is absolutely a lagging indicator, meaning when an unemployment rate is high, it's already too late. We're already in a recession. And so you look at this time series, all those bars going across a recessionary periods. And what you'll note is that the unemployment rate wasn't high when the bar started. The unemployment rate was low. And then the bar started. That recession had already begun when the unemployment rate starts to rise. And so I think if we're hanging our hat on the low unemployment rate, I think it's a thin reed to lean on, because we could certainly hit a recession after going up just 0.5% in the unemployment rate. And then it'll just continue to go higher and higher as we enter the recession. Unemployment rate was at 3.4% a couple of months ago. This month it came in at 3.7%. So again, a little bit of a cross current, a lot of good positive news on the labor market, but that unemployment rate going in the wrong direction, which is cause for concern. So do we think that we're going to hit a recession? Our answer, yes. Ultimately, we do think a recession is likely. We would put ourselves in we could certainly make a case for each of those outcomes: hard landing, soft landing, and no landing. But ultimately, we do think a hard landing is probably the most likely outcome. At the end of the day, we've had 9 tightening campaigns over the last 50 years, excluding this one. In all but 2, we've hit a recession. The only 2 that we haven't, we only raised the Fed funds rate 250 basis points. So anytime we raise the Fed funds rate this much, especially this quickly, a recession has always followed. And so it's just so hard to keep us out of a recession when we're doing that. So ultimately, we do think a recession happens, but we do think it's going to be a pretty mild recession. Think 1991 recession. That's probably a little bit more likely than a 2008 as an example. It's just, we look at the consumer and how strong they are. We look at bank lending standards and how strong they've been for so long. They've never really weakened. They never really threw the towel in and said, hey, let's just lend to anyone we want. They've kept it very tight, and that's a good sign. So a lot of things that we look at that says it's probably going to be pretty limited. What I will say is it does look like this recession is getting pushed out. I think 2023, there's very little probability. It's really a 2024 event, probably second half. And that's a good thing, because I think if it happened today, we would probably have a harder recession, because the Fed would not cut rates to support it. But as the more we get pushed along and into 2024, hopefully we do see a drop in inflation, and now the Fed is going to be a little bit more willing to cut rates to help support getting us out of the recession more quickly. So the only thing I'll just wrap up with is, and I'm running out of time here, I apologize, but we do favor bonds over equities right now. On the equity side, definitely shoring it up, getting higher quality, moving out of we moved out of China, emerging markets at the beginning of the year, bought more US and developed Europe. And then on the bond side, we're just big advocates of locking in these yields. We don't think they're going to be here forever. We think the yield curve is going to shift lower over time as inflation comes down. It could take a little bit of time, but ultimately, getting a 5.5% coupon, which is what you can get right now, lock that in for an extended period. It's going to be hard to imagine an environment where you're kicking yourself for doing that. And so I will stop with that, and happy to answer any questions.
All right. Thank you, Christian. As a reminder, if you have any questions, please put them in the chat. All right, question number one. Does the spending and saving metric include the rising cost of living, for example, rent, medical expenses, or just discretionary spending?
It's just discretionary. Are you talking about the DPI, which I'm sorry, which series?
Percentage?
Yeah, so that's just disposable. So that excludes all of those things, and it's just after all of that.
Okay, thank you, Christian. Next question. This one's about housing supply. What about existing homes? As the baby boomers die or go into long-term care, their homes become available.
Yep. Yeah, great point. And that's something that's happening now. And I think that's absolutely something that, home builders, as an example, are looking at. That's a little bit of a longer term kind of trend. I think it's, something that's going to play out over, the next decade or so. But absolutely should come into account. And I think that's something that will add to the supply and help alleviate some of the mismatch there. But in the near term, I'm talking again 12, 18 months. There's just not enough of that's going to happen to, that 7.5 million is just not going to be enough to is not going to be offset enough by that. So that should keep home prices stable. But it's a great point. Absolutely something that's going to occur as they downsize.
Thank you, Christian. Next question. We've heard today that wages are going up and percent of GDP to labor is going down. How can attendees reconcile these two concepts? What conclusions can attendees draw?
So I'm sorry, say that one more time. The wages are going up.
And percent of GDP to labor is going down. How can attendees reconcile these two concepts?
Oh boy, I'm not really sure. Percent of GDP, percent of labor and GDP. I'm sorry, I'm not too knowledgeable about that. I'm trying to think. I mean, I got to imagine it's just because there's less people in the labor market right now. That 3.5 million that's offsetting any of the increase in, the increase that we're seeing in wages. That 5% increase that we've seen over the last handful of months is, I have to imagine it's being offset by just 3.5 million people not being in the labor force. So that's a lower percentage, but I'm not really sure about that metric. I'll have to look it up.
Okay. Thank you. Next question, content pack presentation. Thank you for that, Christian. What is the actual CPI rate now by the 1970s measurement formula? Does anyone show charts on that basis?
Not that I'm aware of. That by the 1970s, like using 1970 as a kind of a starting point. Is that what you mean? I don't see these questions.
The question mentions the 1970s measurement formula. So presumably the measurement has changed since the 1970s.
Gosh, I don't know. I'm sure it has changed. I mean, it changes quite frequently, actually. They try to tighten the screws periodically to make sure that it's a good gauge of current trends in consumption, but I have no idea what the 1970s measurement was.
Okay, thank you. I think that's about it. Jerry had a comment, the prior presenter, the declining trend of labor versus GDP is over a long period, not necessarily a prior year or two. So that adds a little bit more color to that initial question. And I think that's about it then. Christian, thank you for the presentation, content packed. And everybody, thank you for attending the ACSW Day 4 presentations. Please join us tomorrow, Friday, for the last day of the ACSW Spring 2023 meeting. Thanks to both of our presenters, Jerry and Christian, and thank you for all of our attendees who are here with us today. I think that concludes the content for today. Kathleen, if you could stop recording, that'd be great.